Hi, Brandon Davis with Davis CPA Group. Today I want to talk a little bit about rental properties. You know, a lot of times I get asked questions about, different types of investments that one might want to get involved in. I've got clients that, have good sources of income and they invest in the stock market, they invest in real estate in some different capacities. But one of the ones that they often gravitate towards in the real estate area is rental property and kind of what that looks like. And so some of the questions I get relate to, well, what does that do to my tax return? If I have a loss, is that deductible? How do I track and what information do I need to keep track of when it comes time to do my tax return? So we're going to talk through that a little bit today. So today's topic is rental property. And we're going to focus primarily on residential rental property, meaning the rental of a house, a duplex, apartment complex, residential rental property. Commercial rental property is a little bit different, and it's mostly just different in the way it's depreciated. So residential rental property, in this fact pattern we're going to talk about today, let's talk about a house. Let's say we have a house we paid $150,000 for. And it was a house and a lot. And so we had it appraised when we bought it. The house is worth $120,000, and the lot that it's sitting on is worth $30,000. And this is information we need to know. And so I'll explain to you why we need to know this information. So you got a house worth $120,000, land versus $30,000, and you paid $150,000 for the whole thing. Well, that's great. That's step one. Step two is I got to find a tenant, right? So I find a tenant, I get it leased out, and I'm going to lease this property out for let's say $1,000 per month, okay, in rental income. Well, okay, great. I bought a piece of property. I got $1,000 that I'm going to basically get a month for it. Now what? Well, you got to figure out, you certainly want to put together a good lease agreement, and you want to get an attorney involved to do that, so that way you're protected as far as your rights as the landlord and the tenant and such. You want to make sure that you open up I generally recommend we open up a separate bank account or some other way to track the activities you're going to have associated with this property, because as you buy it, that's step one, but you're also going to have improvements that you make to it. Any major improvements that we make to it as we go along may need to be what they call capitalized and depreciated. If they meet certain thresholds, both on a dollar amount or the amount of work being done to the property to improve its useful life, meaning make it last longer, maybe additional costs that we've got to add to the original cost basis. So I want to talk a little bit about that basis. $150,000 was your original cost. There's another term for that that's used a lot of times in the tax world called basis. So your initial basis in this property is $150,000, $30,000 in land, $120,000 in the house. Well, you're going to take that land and you're going to capture that cost and maintain it over the life of your ownership of that property. The $120,000 in the house cost, you get to depreciate. What that means is you take the $120,000 of cost associated with this property and you depreciate it over time. There's rules in the tax world that dictate what that depreciation looks like. And so on a rental property, residential rental property, it's depreciated over 27 and a half years is what that looks like. Now there's some special rules that go a little deeper than that. It's what's called a mid-month convention, meaning we have to take a rate depending on what month of the year it was placed in service. Then we depreciate it based on that rate, but effectively it depreciates fully over about 27 and a half years. So I'm not going to get into the weeds a little bit on that. All right, so we get to depreciate a piece of this property. I mean, we get to push over, so we have $1,000 a month in income. So it's going to work out to annually to be $12,000 a year in rental income, if we have it rented the whole year. So now we have to track our income, and then we track our expenses associated with this property. Well, you may have utilities expense, so you want to track that and put that in here. You're going to have property taxes. And utility expense, you may pass some of that on to the tenant, but you may cover some of those yourself. But again, your lease agreement is going to dictate some of that. You're going to have property taxes that you have to pay. You're going to have insurance that you're going to want to keep, and you're going to want to get a good insurance agent and make sure you're properly insured on your property. So you have that as an expense. Any repairs and maintenance you do on the property, painting it, lawn maintenance, things of that nature. Anything that you have associated with operating this rental as a business, if you will, because it is somewhat of a business. We're going to talk about that a little bit later. But anything associated with operating this rental property is a potential deduction against the rental income. The other thing you get to do over here, you get to take depreciation expense. So whatever the cost value is, divided by that ratio that gets us to that annual amount to deduct 27 and a half years over the life of the asset, that's going to come over here as a deduction. If you borrowed money to buy this property, so say for example, it was $150,000 purchase price, you put half of it down, so you borrowed $75,000 and you pay interest on that loan, your interest expense will be a deduction down here. And so you add up all of these expenses against your income and you get down here to your net income from the rental property. And so I want to start here and kind of talk through, okay, what happens with this? This activity is reported on your personal tax return if you hold the asset personally, or even if you held it in an LLC. I talked about LLCs before. It's a way to, it's an entity you can set up to own real estate or assets or a business. Even if you owned it as an LLC and we owned it as what's called a single member LLC, which is disregarded for tax purposes, you can find my video on LLCs and you'll see some more information about that. But if you own this personally or as a single member LLC, this activity gets reported on your personal tax return on what's called a Schedule E. So if you ever look at your personal tax return, you get it out and you look at page 1, there's all these line items, right? There's a line like line 7's for wages, and you got interest and dividends, capital gains, and then there's a place where you put Schedule C's for business income, Schedule F for farm, and there's a place called Schedule E, and it says something in the nature of income from S corporations, partnerships, real estate activities. That's where this gets reported. So you add a schedule to your tax return, you report your income and your expenses, and that net number goes back to page 1 of your tax return and gets added to all your income that you pay tax on. Well, I know you're thinking, well, that's great. I got more income I got to pay tax on. Okay, well, how's it taxed? Well, it's taxed at your ordinary income rates. It's not subject to self-employment tax like a sole proprietorship or a business would be, because it's considered a passive activity. Rental property by its nature is considered a passive activity and not a business activity, so it's not subject to self-employment taxes. But also these passive activity rules open up other things we got to be thinking about, particularly when we go to a loss situation. So let's say, for example, and I'm going to erase some things to kind of clean this up a little bit. Let's say, for example, that we went through this scenario where we had our $12,000 in rent and we had all of our expenses. So say $12,000 in rent, and this is on an annual basis, and say our total expenses was $15,000. Okay, and I just summarized that. So this is your rent income, and these would be your expenses. And that $15,000 in expenses include your depreciation expense from the cost basis of the property, interest expense on the loan, property taxes, all those things we discussed. So now I got a $3,000 loss, right? Well, this $3,000 loss goes to the front of my tax return on page 1 and offsets my other sources of income in most cases. There's always a caveat with tax law. So what happens is I get to take this passive loss against my other sources of income, unless my income is over certain thresholds. If that's the case, there's passive activity loss rules that come into play that may limit my loss. And so if my AGI, adjusted gross income, is over about $150,000, so it's kind of talking high level here, then I start getting to a point where I might get phased out of being able to deduct this loss. And if that happens, I don't lose the loss, it just carries forward until one of two things happens. I have positive income in this activity, frees up that loss, and then reduces that taxable income in the future. Or if I sell this activity, and I'm going to say, for example, I've carried this thing for 5 years, I've lost money every year because I can't keep anybody in the property, or I keep having to repair things, and at the end of 5 years, you know what, I'm done, I want out. Well, I say if I've lost $3,000 a year for 5 years, I've accumulated $15,000 worth of losses. The year I sell out and dispose of the property, and I sell it for whatever I can get out of it, I pick up any gain or loss on whatever my adjusted basis is, and we're going to talk about that at another time. But I sell the property, it frees up all my losses at that point in time. And so that's kind of those passive activity loss rules work, and that's really the big thing that is often a surprise for some people when it comes to rental properties. Because I have some clients that say, well, I'm going to dump all this money into it and get this big loss in the first year. Won't that give me a big tax savings? Well, it'll give you some tax savings. Because one more thing we got to talk about. Even if you're under the income limits where you're able to deduct this full $3,000, there's another limitation that the max amount that you can deduct from rental property as a passive activity loss any 1 year is $25,000. And so if this were to be a $30,000 loss in year 1 because of all the stuff we did to it, well, we'd be limited at $25,000, and $5,000 would carry forward to the next year as a passive activity loss carry forward to offset future income from the rental property. That's kind of the big thing about rental properties. Again, they can be great investments. You're obviously buying an asset that someone else is helping you pay for, because generally speaking, rental properties and real estate go up in value over time. And so it can be a great avenue to have some future retirement income. It can be a great avenue to have some supplemental income, and use these to kind of build off each other to build a portfolio of rental properties. But knowing these passive activity loss rules, knowing how to properly structure your rental properties, what things to keep track of from an income and expense standpoint is very important. And that's where you want to get a professional involved to help you make some of those decisions and walk through how to set these things up. If you have any questions, please reach out to us at Davis CPA Group, and we'll see you next time.